50% of the money that is issued by central banks all over the world is hyperinflationary, and in some countries not worth the paper it is printed on. And so when people start to fundamentally believe that an entirely self-sovereign asset class can exist that empowers people, enables them to exchange value, and supports an always-on global economy where the rest of the economy takes bank holidays, that's powerful. And that's now well beyond a tipping point of millions and millions of users all over the world. Those votes matter. And I think that's what people often negate when they call for the big short and they describe blockchain and cryptocurrencies and Bitcoin specifically as an asset with no intrinsic value.
That's Dante Disparte, and this is the All Things Risk podcast. Welcome and welcome back to the All Things Risk podcast. I'm Ben Catania, your host. This is my show where we use the lenses of risk and uncertainty to understand ourselves and our world a little bit better. This is the second of two consecutive episodes about cryptocurrencies and blockchain. You do not have had to have listened to the first episode with Ethan Liu in order to get a lot out of this one, but I do recommend that you check that one out. With Ethan, we covered the Wild West of cryptocurrencies. Today, we continue to talk about the risks and uncertainties in this space, but our focus turns to the present and the future of these technologies. We talk about stablecoins. We even have a prediction or two. And I am delighted at being able to bring to you my conversation with Dante Disparte. Dante is a global leader in harnessing risk and emerging technologies like cryptocurrencies and blockchain to improve economic competitiveness and resilience. He is currently the Chief Strategy Officer and the Head of Global Policy at Circle. Circle is a digital financial services firm, which among other things has built the US dollar coin USDC. Prior to this, Dante was a founding executive at the Diem Association. Diem, or Libra as it was earlier known, is the blockchain payment system of Meta, which until very recently was known, of course, as Facebook. Dante was also a member of the National Advisory Council for FEMA, the USA's Federal Emergency Management Agency. And if Dante's name is familiar to you, perhaps it's because he co-wrote Global Risk Agility, a book with Daniel Wagner, who has appeared several times on All Things Risk. We get into a fair bit in this conversation, including the world of cryptocurrencies, blockchain, and their risks and opportunities. And included in that is Dante's own view of Nassim Taleb's prediction that Bitcoin goes to zero. Nassim Taleb, of course, is the author of The Black Swan. Dante respects Taleb a great deal, and he was even Dante's professor at New York University. But as you will hear, Dante does not agree with him on this particular prediction about Bitcoin. We talk about stablecoins, what those are, and what Dante calls digitally enabled secure networks, and some really fascinating applications about these technologies, or potential applications of these technologies. And we talk about systemic risk, climate change, and a range of other use cases for these things. We get into cryptocurrencies and geopolitics, what the future holds, and a lot more. So let's jump in. Here is Dante Disparte. Dante, welcome to the All Things Risk podcast. It's a pleasure to have you on.
Thank you, Ben. Great to be with you.
This is going to be very interesting indeed, and we are going to tackle some incredibly timely topics that are pertinent now and well into the future. Before we do that, it would be great if you could give a little pen portrait of your background for my listeners.
Well, absolutely. I think to your listeners, they may know me from the risk and resilience domain. But today I come with a hat of representing a company called Circle, a leading digital financial services firm and the issuer of a digital dollar called USDC, where I serve as the chief strategy officer and head of global policy.
Mm-hmm. So what I'd like to start getting into a little bit is you can't go anywhere without some kind of headline about cryptocurrency these days, whether that's in your whatever newspapers you follow, read. They're all over Instagram. There are all kinds of things going on. And before we dive into what you're currently doing now, I'm just wondering if you could give a little bit of background, your take on what both cryptocurrencies are when you're asked to explain them, and blockchain, and why these things are disruptors, if you like. What's happening in this space? How do you explain these phenomena?
Sure. Well, for one, you've got to think about how they were born in the first place, right? So more than 12 years ago now, post 2008 global financial crisis, I think a degree of frustration around privatizing gains and socializing losses in the financial system started to also raise the opportunities for alternatives for payments and how value would move around the internet. And so you could argue that the origination story for this novel industry begins with the anonymously published or pseudonymously published Satoshi Nakamoto white paper, also known as the Bitcoin white paper, that called for an internet of payments and then brought to light this foundational technology, blockchain, as a way of ledgering transactions and creating technological scarcity. At the same time, the technology brought to light the concept of distributed systems, where in order to alter the system, you would have to compete with and combat all of the servers on these networks at the same time in order to create an erroneous transaction or an erroneous record. And so that then opened up on the optimistic and positive side of the spectrum, the concept of democratizing value and payments and preserving people's privacy. On the risk side of the spectrum, it also opened up a whole world of anonymous payments and not knowing your counterparties and sort of effectively moving money at the scale of the internet without really understanding who your counterparties are. So as you can imagine, this creates quite a lot of both opportunities and risks as this novel industry emerges. And then today, it's a more than $2 trillion asset class that rides on that foundational technology of public blockchains.
Can we jump on a word that you just said, a term there, asset class? So I studied, as many would have studied, economics, just your economics 101 class. And when you open up the textbook and you look at what is a currency, and it has three criteria. One is that it's a store of value. Two, it's a unit of account. And three, it's a medium of exchange. And when I'm trying to, and many have, wrap their heads around Bitcoin or any other digital currency, it doesn't seem to meet very well any of those three criteria. So what is it? Is it a currency, or is it an asset class? Is it something else that we just don't have a textbook definition for?
Yeah, it's a novel concept. So with that same Bitcoin white paper that I mentioned before, a really important economic point was introduced about scarcity. So at all times, there would only be 21 million Bitcoin ever minted, or ever mined, rather, is the right term, not minted, mined. And we can get into a little bit of the description of these terms of art. And so as a result, the very early adopters learned that this would not only be a rapidly growing speculative asset, an expectation of volatility and high risk and potential high returns. And so it shifted from originally being conceived of as a payment instrument and a payment network to effectively a version of digital gold. So an asset in which increasingly not only institutional users, but obviously retail users are buying into as a store of value and as a speculative instrument. There's a whole sort of thesis around, are these innovations uncorrelated from capital markets and traditional capital markets risks? But nonetheless, the prevalent case for how Bitcoin is increasingly being used today, including being placed on company balance sheets to the tune of billions of dollars, is as a store of value. Now, around the Bitcoin innovation and the innovations of public blockchains, there is a whole host of other industries that have cropped up and other asset classes that have cropped up. The concept of a creator economy, this notion of what is known as a non-fungible token. So you being a creator, envision a world in which your next instance of internet productivity, you were irrevocably the owner of that internet productivity, and that you could permission in or permission out literally the entire world or no one at all, and have this concept of digital scarcity accrue to you, the creator, as opposed to the operating model of how things are syndicated on the internet today. So the same foundational technology, blockchain, is powering that new innovation. It's also powering innovations known as stablecoins, which are to the internet what a dollar is to you and I for daily transactions. And it's cropped up a greater than $2 trillion entire market around public internet infrastructure.
So I want to get into some of that as well. What I also, just before we do, I want to bring in, I don't know if you've seen this video, Nassim Taleb does a 13-minute video where he explains why he believes, and he wrote a paper on this, that the value of Bitcoin will go to zero because it's not a currency, so he dismisses the fact that it's a currency. Then he says, is it a security? And he says, well, a security's value is dependent on its cash flows plus its expected future cash flows. And it has neither of those things. So the conclusion is, effectively, it goes to zero. And I respect Nassim Taleb, but I'm not sure he's correct there. And I'm just wondering if you had any thoughts. If you said it's a store of value, and if companies have the asset on its balance sheet, and it's a form of digital gold, I suppose, then would it be fair to say that you disagree with Taleb's assessment?
Well, Nassim Taleb was one of my professors at NYU Stern, so right. I have great deference for his thinking. I have, in a book I co-wrote with Daniel Wagner, a frequent guest on your podcast, we pay homage to his concept of anti-fragility and sort of our approach to risk management and, what we call risk agility. Now, the distinction, however, is part of what people are buying into when they're investing in Bitcoin as a store of value is what the underlying technology allows for. So I think people often negate how distributed open technological systems are really powering a completely novel layer of how trust and how exchanges of value and other novel business models are emerging. And so I think there is a degree of short-termism when people try to pigeonhole novel technologies into existing frameworks.
Right.
The other piece of the puzzle is what distinguishes humanity, our species, from other complex organisms and species on the planet is our ability to ascribe collective belief systems into concepts and institutions. And so Yuval Noah Harari makes this point in his book Sapiens, that's one of the big distinguishers. And so 50% of the money that is issued by central banks all over the world is hyperinflationary, and in some countries not worth the paper it is printed on. And so when people start to fundamentally believe that an entirely self-sovereign asset class can exist that empowers people, enables them to exchange value, and supports an always-on global economy where the rest of the economy takes bank holidays, that's powerful. And that's now well beyond a tipping point of millions and millions of users all over the world. Those votes matter. And I think that's what people often negate when they call for the big short and they describe blockchain and cryptocurrencies and Bitcoin specifically as an asset with no intrinsic value.
Right. That's a great explanation, probably one of the best explanations I've heard about this for some time. So thank you for that. And it's demonstrative of the power of collective belief, which has value, right? There's value in collective belief. And
well, indeed there is. And just to drive home the point, emblazoned on the US dollar are the words "in God we trust." And to some people, especially think about a brand new generation of people in whom technology they trust, they're used to instant gratification. Their experience of being banked, so to speak, is to have never, ever crossed the threshold of a physical bank branch. And to perhaps our generation, novel innovation was the ATM, which is very incremental. Whereas a brand new generation of people all over the world, their experience of being banked and their experience of being connected to the internet is mobile enabled and always on. And yet, when you think about how value transfers today, it takes bank holidays. It's slow. It's labored under lack of interoperability all over the world. And so this is really an industry serving a big generational shift, born again from frustration post-2008 financial crisis, but addressing, I think, a whole series of market needs that are hard for many people to fully understand.
And the word credit, it has its Latin roots in credere, which I believe is to either believe, I think it's to believe or to trust. I mean, the credit card, when it came out, a piece of plastic that people were using to pay for things must have been alien for people that relied on cash, right?
Yeah, absolutely. Well, and these types of challenger business models, and this is kind of the place we are now, right? Our company's Circle is to banking what a Tesla is to the internal combustion engine, in that you could still get mobility, but you're not necessarily killing the fundamentals of what the market wants or what people want, right? They want banking and financial solutions that follow their actual needs and that are always on, like the global economy is. And I think this is where the COVID-19 pandemic really showed where, the technology around the world was a difference maker for everything except for how money moves and how value is transferred at scale. And so I think there's some really powerful lessons in terms of how these technologies and how blockchains coming into the main stage in financial services are important in the financial system.
Yeah, I think that's very accurate. And I want to transition a little bit here, because before we dive into some of that, one of the things that I think give a lot of people pause when dipping their toe, investors and others dipping their toes into cryptocurrency, is some of what we have seen in that space when we talk about trust. And we've seen loads of frauds and scams, both in terms of exchanges that have turned out to be fraudulent, in terms of cryptocurrency being used for nefarious purposes, drugs and arms and all kinds of things like this on the dark web. We're still seeing, lots of pump and dump scams and the so-called shit coins that are out there, and the whole, ICOs that have come out, that initial coin offerings that have come out, and I think something like 90% of them have turned into nothing. So there's a lot out there that one would not want to trust, because there's a history so far, kind of a potted history. Certainly people have made money, but there's some things out there that aren't particularly appealing.
Yeah. Well, and again, I've written at each of the junctures that you described over the 12-year maiden journey of this technology and of cryptocurrencies kind of emerging on the scene. I've written at each of those junctures, I think, reasonably well-timed theses and articles on what were the types of risks the industry introduces. And then, frankly, the other operating reality is that every emergence of novel technology would either amplify the very best of our species and the very worst of our species. So blockchains did not introduce human greed and the misdeeds that people could carry out if they could obfuscate their financial transactions and their financial motives. So there have been a whole host of teachable cases about what would happen if money could move on the internet and at the speed of the internet. There's also, in my mind, a great series of counter arguments that, notwithstanding the risk-reward calculus of this novel industry, the rewards far outweigh the risks.
Okay.
And increasingly, because in a decade, We have culled all of the unstable coins. In a decade, the ICO bubble has come and gone. And in a decade, we have addressed this question of internet funny money and quote unquote vaporware, where any company with a slick website was able to introduce a token of some kind. I think the market is starting to gravitate towards really well-regulated, high-trust standards that are showing that what these innovations are really all about is completing unfinished work in the global financial system as opposed to competing with it. And so on the score, for example, of financial crime compliance, where there's often a conflation of cryptocurrencies equal ransomware or illicit activity, I actually think these technologies and the fact that you have transaction recording on public blockchains down to micropayments are really, exacting a higher cost on the bad actors in these systems as opposed to penalizing all of the good users of the financial system. And think about that in your own financial interactions, Ben. That for you to get a bank account, the burden of proof and the burden of trust is on you. And at the expense of putting all of your personally identifiable information into one of 3 credit bureaus on the planet, you get a basic bank account. Now, if a basic bank account is a human right, I don't think you should suffer a lifelong liability of personal identity theft for the very basic access of financial services. But yet that's the model we live by today. These technologies are enabling privacy-preserving basic financial access at population scale. And I think that's super, super important to combating risk, financial inequity, and a whole host of other challenges.
Let's maybe talk a little bit about that and how these technologies can be used to combat, wealth disparities and income inequality. And as you were speaking as well, I was thinking about another conversation with a different podcast guest, Oliver Bullough, who wrote a book called Moneyland, and he talks about how using fiat currency, basically, the world's most corrupt leaders can do all kinds of things to disguise their ill-gotten wealth in a place called Moneyland, which is not really a physical place, but it's Moneyland is it particularly in London here where I am. We've got loads of people that live in Moneyland who they're buying properties and football clubs and everything else under the sun, and that's all done through the legal system, and accountants and lawyers are facilitating that. So how can some of these innovations in financial technology combat some of that?
Yeah, well, I've often said to people that if you wanted to launder $500 million of ill-gotten money, then it's not likely you're going to turn to a public blockchain as your transaction ledger for that ill-gotten money, because as they say, follow the money, then these networks are enabling people to follow the money in real time down to microtransactions. And as an example of that, the Robert Mueller post-election interference case in the United States indicted 12 Russian nationals in no small measure because a lot of the way the money was moving around, even though the digital wallets, the identities of the digital wallet owners were not known, the money flows were being tracked and traced on public blockchains. And so there's a growing body of evidence that are suggesting that for leapfrog improvements in financial integrity and financial crime compliance, a lot of the world's financial intelligence units really are starting to favor this method of recording money flows and value transfer, as opposed to the alternative, right? The Panama Papers, the Paradise Papers, the Pandora Papers, you pick any one of the global misdeeds in terms of how we are legitimizing zero participation in terms of tax receipts, zero participation in terms of reporting ill-gotten goods, and having the banking system file suspicious activity reports, amongst many other steps. The scorecard is so checkered for the traditional banking system that short of exponential improvements with the technology that we use to ledger transactions and money flows, it's hard to say we're going to have any better outcome in terms of fighting bad actors and corruption, bribery, and fraud. The system is opaque, and for many, that's a feature, not a bug. Right.
And on the other side of the ledger, one of the guests who will probably appear just before this one, Ethan Liu, who wrote a book about the kind of Wild West of the crypto space, shared a story in which an Afghan refugee who was fleeing just after the fall of Kabul with nothing except for her Bitcoin wallet memorized, was able to get to Germany and get access to a couple $100,000 worth of Bitcoin and start a new life. And I thought
that's part of the ultimate premise, and this is why the real long believers in what this technology means for financial empowerment are often thinking about that concept of self-sovereignty and the portability of your value. Now, I will extend this to what the listeners will appreciate, right? If you think about what mobile phone portability meant for you and your personal relationship with your telephone number once upon a time. Remember when your telephone number was locked to your mobile company provider? Right. Now, if that telephone number was also your bank account and was also the deed to your land and your ownership and the representation, albeit digitally, of everything that you've ever valued or cherished, wouldn't it be nice if it conveyed to you and you had universal portability with it? So that's exactly what these innovations really mean. It means that value can be represented without a double counting problem on the internet and empower people and create self-sovereignty and democratization of assets. So that's one really important piece of the puzzle, and it's also a very real way in which the advent of digital currencies are moving the needle on important issues with financial inclusion. The other issue is think of the cost of global payments and money flows. The global flow of peer-to-peer payments or remittances historically have been recession resistant. They're also bigger and more important and more persistent than foreign direct investment or official government development aid. And yet, because of the void of competition, most remittance corridors are duopolies at best. People who could afford it the least pay the highest prices for very basic global payments. These payment systems, based on public blockchains and little more than a digital wallet, have also started to move the needle on lowering these costs and increasing the speeds and the settlement times of cross-border payments as well.
Right, and for some of the world's poorest who work as migrant workers, for example, and sending payments home, that there's an advantage there.
Absolutely. Well, and the one thing I would also say, but again, before entering this world, I come from a world of the risk and insurance domain and have done a lot in the humanitarian sector. If you want to spur corruption, bribery, and fraud in a developing country, send pallets of cash as disaster relief and aid. And so I think there are some incredibly powerful use cases of these technologies in corruption-resistant aid and relief disbursements. Because if nothing else, at least you have certainty on the point-to-point beneficiary and sender information, and you know exactly what sum of money has been transmitted. You could also do some really novel things with geo-referencing and the rest to make sure that you stay free of OFAC-sanctioned countries and other potential bad actors in the financial system. So here, too, we're moving from abstraction to operation with a whole host of use cases on humanitarian intervention.
You did mention earlier the term sovereignty or self-sovereignty, and some of the early adopters and still the people that are really long on Bitcoin, the hodlers, the whatever Bitcoin maximizers, whatever they're called, they're extreme sort of libertarians, right? So they believe in the power of individual sovereignty, but there are some limits. We need some consumer protections, and that implies institutions, right? That we need some type of, well, we don't need, but I think in order to clamp down on the nefarious uses of this stuff, and in order to protect consumers, and we've seen all these cases of scams and things there, it does imply that some amount of regulation, some amount of compliance is required. And so I'm just curious as to where you come down on all of this in terms of, well, there's in some ways what I hear that you're saying is there's an opportunity to reset a few things with regard to regulation of financial markets in order to address some kind of big systemic risks out there. But that does imply that we need institutions, regulators, things of that nature to get on board and to step up. So I'm wondering where you come down on this. Yeah.
Absolutely. I mean, and I would say just as the movement of money on risky, rickety wooden Spanish galleons was risky, and in the same way that the movement of money on stagecoaches during the U.S. westward expansion was risky, so too has been the movement of money and value on early public blockchains, right? And so in that maiden 12 years, I think it's probably the world's fastest acceleration of a boom to bust cycle to get to a point of regulatory parity with like for like payment systems, banks, exchanges, capital markets providers. I think this is actually an incredibly well-regulated space. And one of the things that even the so-called Bitcoin maximalists have started to trade on or trade for is when you are effectively your own custodian of digital assets, then effectively you are your own bank. And there's an entire cottage industry that has cropped up around these services that didn't exist 10 years ago around custody, the care, custody, and control of these types of digital assets. And they start to look not dissimilar to the very banks this technology was supposed to disintermediate. So that's one of the ironies that this is no longer seen as marginal technology or fringe technology to the core of the banking and financial system. If anything, it's now the core of the financial and banking system, right? And you see that evidence of that is companies like JP Morgan Chase, who famously Jamie Dimon said, if anybody is ever caught trading this, we would fire them. To today, it's one of the leading companies in terms of the deployment of blockchain technology in real world use cases for commercial transactions and so on. So I think that's exactly where we are. And just like the emergence of the internet, there were stalwarts who ignored it. And then ultimately their business models may have been gobbled up by the internet. And then there were the early adopters that figured out how to embrace it, harness it, and then normalize it. And I think that's exactly where we are with what I classify as the internet of value, and some are calling Web3. That's exactly where we are in this race. Right.
Can we talk a little bit about, from there to this concept of stable coins and what a stable coin is? And you worked with Libra, or Diem as it is now called, and both what a stable coin is and the Libra Diem and that concept. What is it? What is it trying to do? And how does this add some risk management individually and to the financial system?
Yeah. So today, Circle, my current company, is the issuer of USDC, a stablecoin, but more so than a stablecoin, because like the blockchain technology we just discussed, not all stablecoins are created equal, which is part of what is animating a global review of risk and compliance and prudential standards for these innovations. But Circle is the issuer of USDC, and USDC, in our view, is a dollar digital currency that is meant to address the buyers and spenders remorse that we discussed a moment ago about Bitcoin and some of the early cryptocurrency innovations, where they were either too speculative and volatile to be a real medium of exchange, meeting the three standards you set: unit of account, medium of exchange, and store of value. And so what the stablecoin is solving for is an internet native medium of exchange that can then power low friction, high trust payments across a range of these open blockchains and open sort of financial infrastructure. This is now very real. So yes, once upon a time, I was one of the founding executives of the Libra project. Today at Circle, USDC in circulation have powered more than $2 trillion of on-chain transactions. The growth of USDC has really demonstrated the need that around the world, people's financial needs do not take bank holidays. And so increasingly, USDC is becoming the currency of choice to represent a dollar on the internet. And this is powering entirely novel markets, but also bridging a world of connectivity between internet level payments, but the real world as well. So companies like Visa, MasterCard, recently MoneyGram, announced the use of USDC as a settlement option as well on those networks. So this is the point where it starts to get really interesting, Ben, because I think the technology then fades to the background, and what we discuss are the outcomes, and the market experience is always on forms of money that we can transact at scale.
Right. And so the difference between USDC and just a US dollar payment on the over the internet would be that a USDC is backed by blockchain and an open ledger.
Well, yeah, and the one of the better metaphors for why the innovation really is a breakthrough is imagine how usable your email network would be if you could only email another Yahoo email account or an email account, right? The reason email as a standard makes sense around the world and was a challenger when it was first introduced is because of the concept of ubiquity and interoperability, right? And so what USDC is powering and what Circle's services power is this concept of ubiquity and universal transferability of value on the internet. So most of the world's payment systems today are living in proprietary technology standards, which create walled gardens or silos. And so you and I, if we had to send money from London to Washington right now, before this podcast interview was over, we would be hard pressed to be able to do that, but for these types of open technologies. And so that's where I think these are real powerful breakthroughs and, increasingly totally inside the regulatory perimeter and producing exponential gains on financial inclusion, innovation, and integrity.
Yeah, that does sound quite exciting, and certainly we're heading into a new world. I was wondering if you could share a little bit more about Circle and your work there and what it does. You mentioned USDC, but what is Circle's mission and what is it set up to do? And go for it.
Yeah. So look, our mission really aligns so deeply with what I think I'm put on the planet to do. So, the company has a very aspirational mission of raising economic prosperity through the frictionless exchange of financial value, right? That we want to be one of these very early pioneers of building an internet of value that reduces the reasons and the excuses for why either people are on the margins of the financial system or companies are being preyed upon by insidious rates of fees, exchanges, very slow outcomes in how they have commercial transactions today. That necessitates competition. It necessitates increasingly the commoditization of how money is moved around. But it doesn't mean that you have to do this and introduce more risk to people, to users, and to kind of continue amplifying the internet funny money challenge, right? So we think those things are not trade-offs that you could build, and we're demonstrating that, right? So that's what Circle does. We're the principal issuer of USDC. We also enable businesses to interact with these public blockchains and public value transfer networks through the Circle account, which is free for companies to sign up to. And the Circle account powers what I call the 4 S's of payments, how people send, spend, save, and secure their money. And then it's enabling a whole host of use cases. The other really powerful aspect of these innovations, Ben, is this notion of programmable money. Imagine having a zero default loan. Imagine having insurance that pays a claim because your particular geolocation has a disaster and the claim is liquidated instantaneously, parametric insurance. Imagine an escrow account that, could liquidate when trade is satisfied and, the cargo ship is verifiably at port. That whole era of programmable money is part of what these networks start to unlock in really, really, truly profound ways that can pull trillions of dollars of global trade into the 21st century. So there, too, Circle's capabilities and solutions are plugging into real markets, and we're only at the beginning.
Right. So that sounds so interesting. Could you explain how that would work, like an instantaneous insurance claim payment, for example? How would that work? How would you do that?
Yeah. So years ago, I wrote a piece in Forbes, and I have a bunch of pieces, including one in Harvard Business Review, on how the insurance industry could upgrade itself with blockchain. And one of the arguments is, insurance is literally a contract of utmost good faith. In most cases, it's not worth more than the paper it's printed on. And in most cases, the burden of proof to file a claim is on the beneficiary, right? Or on the policyholder. So in many of the types of claim scenarios that insurers face, you have third-party evidence that a financial loss has occurred. So in a flood, It's not hard to get geospatial evidence that the particular property was affected by a flood, nor is it difficult to determine whether it was a total loss or not. Instead, the customer proposition is wait months and months and months and months for a loss adjuster to come out, a claim to be adjudicated, and a policy to be liquidated. All of that adds to cost to both the insurer and the market. And that's what is fueling what is known as the protection gap, the gap between otherwise insurable risks and those costs borne by taxpayers are not insured at all. So the advent of public blockchains and digital currencies attaching to the insurance balance sheet could create a class of coverage that could liquidate upon a claim being verifiable through third-party evidence. So you're staying true to the concept of the aleatory contract that an insurance policy is, but you could change the fundamental economics on how the insurance is actually organized without, increasing the so-called expense ratio or the amount of overhead charged into every dollar of insurance premium. So I have a piece in this. I sit on FEMA's National Advisory Council. I also recommended that these types of technologies should be explored for the mobilization of public disaster assistance and relief. Because when the disaster strikes, speed matters most. And what we labor under are very analog, slow-moving ways of moving money because we don't trust our counterparties. And that's part of what blockchain solves for, is it allows trust to scale to the internet, which by no other technological standard are we able to replicate that.
Wow, that's mind-blowing, honestly. Would that mean that, so for example, an insurance policy and then the associated evidence goes somewhere into a blockchain application?
And think of it this way.
Okay.
Because of part of what blockchains solve for the accounting world's most insidious present problem, which is double spend. That if you and I were in a room alone and I gave you $1, it was your word against mine that transaction actually occurred. So that's double entry bookkeeping.
Right.
And the edifice of double entry bookkeeping today accrues to every public company on the planet, every private company on the planet, tax receipts, every little thing we do of an exchange of value is necessitated or predicated upon by double entry bookkeeping. Blockchain solves for that at population scale, at internet scale, because there cannot be the existence of a single tokenized asset more than once. And so if I spent a digital dollar like USDC and gave it to you, I have done it now under the collective witness of anybody with an internet connection. And so it's no longer your word versus mine. It's now I have to convince the whole planet that registered that transaction that you, in fact, did not get the dollar if I wanted to defraud you. And so if you reduce the cost of fraud and mistrust down to zero, then notionally you could price that back into a lower cost version of financial solutions, insurance solutions, and so on. So that's one real big pillar of why blockchains are so foundational. The second pillar is with digital money on top of it, then it becomes programmable, right? Then you could say, well, I want a self-liquidating policy for my postal address. And if FEMA says, or the OSHA or some other body says that address has suffered a total loss, then why not just liquidate my claim upon that evidence coming in through third parties? What are known as oracles in the industry, but then you maintain the economic concepts of the insurance contract, but you're now adding the element of a financial ledger in which no two claims can be paid, along with programmability of money so that the money can be dispatched and paid out along with the claim being verified. So you could remove months from start to finish in terms of how claims are processed in the insurance market, while at the same time giving insurers a way of pricing in a more advantageous technology-powered version of their business model.
Right. That's fascinating. That really is quite amazing. Now, I'm going to throw in something here, though, and it sounds like we're just kind of at the beginning of all of this, aren't we?
Well, we really are. And what I can say, though, is that this is no longer an abstraction. If you go through the archives of some of my insurance-related blockchain writing, then at that point, a lot of this was very abstract. And candidly, the market and the world didn't see the necessity, partly because we didn't have the pandemic and partly because climate risk felt like it was very distant on the horizon. fast forward to today, I don't think there is a single person, neither in the halls of power nor in the boardrooms of the largest organizations on the planet, that is not anticipating the necessity of technology as a means of business continuity, but also the reality that big complex risks require completely radical rethinks of how we interact with the market, how we interact with stakeholders, and how we're going to ultimately rise to the occasion of these big complex events. We just can no longer use last century's approaches, institutions, and technologies to solve this century's challenges.
Right. I was going to throw in, though, one of the challenges in that, and if you can look at the United States, you can look at the United Kingdom, and then loads of other places, that institutions and lawmakers they're behind the curve massively, right, in terms of understanding how these technologies work. You just, some of the congressional and Senate hearings around Facebook, for example, are almost farcical in terms of the questions that get asked. So I'm curious what your take is around getting, institutions to get into the 21st century.
Yeah. Well, as someone who sat through 9 hours of those hearings when, for example, the Libra project was first introduced, for little more than a white paper, we were subjected to, I think, an important public policy conversation. But it also gives you a flavor for what is the state of play of private sector innovation, and then which actors are allowed in versus out or kept out of certain segments. In my view, and this, by the way, is holding true with the idea of central bank digital currencies, which is one of the potential public sector responses to how important cryptocurrencies have become, and this kind of digital asset class that we have discussed, in its emergence. The question of, should the government then issue a digital dollar of its own or a pound sterling and so on? I think this is one of the very big global policy conversations. I fall in the camp of the extensibility of the dollar in any of its form factors, whether enshrined on a plastic card, on a check, a traveler's check, a money order, a wire transfer, has always had the right balancing act between public interest and free market private sector innovation. I think the same holds true with the era of blockchain-based financial services, is that we have the opportunity, and certainly Circle has as a company priority, we have the opportunity to enshrine those first principles in code and then ensure that a dollar can compete on the internet while preserving people's privacy and preserving U.S. monetary and sort of foreign policy objectives, if you will. I think we have a chance of doing that much better than an antiquated analog global financial system that has not had a systems upgrade in 50 years.
Absolutely. I am conscious of time, but I did want to just cast the gaze forward a little bit more. And one of the things that is never far behind discussions about policy and policy decisions and regulations is politics, and geopolitics in particular. And we've seen China ban Bitcoin, and similarly we've seen El Salvador adopt it as legal tender, for example. And I'm just wondering if you had any thoughts on where some of this goes. You mentioned central bank digital currencies, and presumably China has, we'll see one soon coming from China. But I'm just wondering where you see the big kind of geopolitical tensions or fault lines around this space.
Well, they are very, very real. And I think in one country's ban of an industry is another country's gain. And so it's no surprise that just as in the macroeconomy, you see flights to quality, you see, the global preference of the dollar as a reserve currency. It is because it is all of the sum of the parts. It's the sum of institutions. It's the sum of trust and fundamental trust in those institutions. And then candidly, it's the sum of private sector and free market activity on how this extends to people, market, trade, and competition around the world. And so, I have a piece in Project Syndicate that actually argues in the digital currency space race, my estimation is that the United States may very well be winning the geopolitical and economic space race in no small measure, because when you think about all of the stablecoins in circulation today, bearing in mind that not all of them are created equal, $100+ billion of them reference the dollar as the underlying asset. And so I think that kind of extension is going to continue. And my hope also is that the United States and the West figure out how to, attract this industry and create what I classify as a blue checkmark moment where there's harmonized market conduct, there's competition, and there's really good free market, vigorous free market innovation, but in the line of sight of public interest and public standards. The sum of that really matters. Now, the geopolitics have a lot to do and a close proxy to the 5G wars, where that if some countries were afraid about privacy and potential corporate espionage and other risks of which firms were building hardware and software for telephony and internet connectivity. Imagine a world in which value transfer networks are no longer conversant with sanctions, financial integrity standards, anti-money laundering, and countering the financing of terrorism standards. That's where we start to see the world cut in two, which is why we need an answer for how the dollar can exist on the internet and compete on these public blockchains.
Yeah, very interesting. And so if you were to, I was going to ask you what you think the next 5 years looks like in this space, but I'm wary, and my listeners are wary of predictions, but so I'll ask you what you hope it looks like.
Well, look, I could not come on this wonderful All Things Risk podcast and not do some super forecasting. So, in my mind, you're going to see, this go from a $2 trillion segment of the global economy to many, many, many multiples that number, in part because there are two camps. There are the crypto committed, the early adopters that we spoke of who bore all the startup risk and who've gone through boom and bust cycles in the span of a decade that would make most mature industries blush. And then there is the crypto curious. And in the crypto curious camp, you see the world's largest banks, the world's largest technology firms, the good ones and the bad ones. The world's institutions are all starting to realize that the emergence of a third generation of the internet, Web3, is here to stay. It is one of the most foundational, important technological developments we have seen, and it's only just beginning. And so my prediction is this stuff is going to get very big, very fast, but it's also going to enhance U.S. and other countries' economic competitiveness the more those countries can provide for regulatory certainty for this industry.
Great. That's fantastic, really useful things. Before we wrap up, for my listeners, and I'm sure everyone who's listening has really found this interesting. First of all, was there anything that you didn't get a chance to mention that you wanted to?
Well, I think we solved for all of it, Ben, which is exactly the standard of coming on to your show.
Fantastic. Okay. And then for people that want to follow you, and you mentioned a few of your articles, and obviously you mentioned Circle, where can they do that? What are some of the best places? I'll put all that stuff in the show notes, but just for someone who's listening wants to, has got their browser at the ready.
Sure. Well, look, I'm reasonably Google proof in terms of my writing, my thinking. You could follow me on Twitter and in other places. And then obviously learn more by visiting circle.com about, what our company does and how we're helping build this internet of value that we've spoken about.
Fantastic. Dante, this was great. I love this, and I'm sure my listeners will as well. So thank you so much for taking the time to appear on the show.
Thank you, Ben. Great to be with you.
All right, I hope you guys found that interesting. Give Dante a follow. Links are in the show notes as usual. And I also hope that you enjoyed these last two episodes that have focused on cryptocurrencies. I have certainly learned a lot, and I have some concluding thoughts. First of all, it's worth remembering, and based on many previous episodes of All Things Risk, that there are always numerous potential futures. Nothing is certain, and everything is probabilistic. So with that in mind, one future is that we may be at peak crypto now, and that things decline from here. That is certainly a possibility, but there are other possibilities. Part of me is still skeptical about the future of some of these technologies and of Bitcoin in particular, although a little bit less so following these conversations. But that part of me could be wrong. And so secondly, I would like to say to you that if you are an investor and long on crypto, or if you are crypto curious or even crypto skeptical, a good question to ask, and I borrow here from two-time podcast guest Annie Duke, is how much would you be willing to bet? And secondly, how could you be wrong? And go from there. Regardless, be wary of declarations of certainty and of black and white thinking. That's it for now, but I'd be keen to hear from you. What did you think of these last two episodes with a focus on cryptocurrency? Are you involved in cryptocurrencies, and what has your experience been to date? Would you like us to talk more about this topic, or would you like to see some other focused topics in the future? And if so, what should we focus on? Drop me a note. allthingsrisk@gmail.com is the best place to do that. We will be back soon. Until then, and as always, don't forget, risk is life.